Welcome to Wealthion. I'm Wealthion founder Adam Taggart here with another short explainer video on a topic many of you have been asking about: how to protect the purchasing power of your wealth using Series I savings bonds, otherwise known as I-bonds. I-bonds are offered by the US Treasury as a way to protect the purchasing power of your money from being eroded by inflation. This is protection many investors want pretty badly right now, as inflation has roared back to life over the past year and a half. After decades mostly spent under 2%, at the time of this recording, the official Consumer Price Index, or CPI, is currently at a 41-year high of 8.6% annualized. The way that I-bonds defend against this is they earn a monthly interest rate that's usually higher than the CPI or close to it. So their return beats or comes quite close to the officially reported inflation rate. For example, at the time of this recording, I-bonds currently earn interest at a 9.62% annualized rate, which is a full percentage point higher than the current 8.6% CPI. The interest rate paid by I-bonds is made up of two components: a fixed rate, which is set when the bond is issued and remains the same for the life of the bond, and an inflation rate, which changes and is set twice a year. So once you've purchased an I-bond, the interest it pays will be recalculated semi-annually when its inflation rate component is adjusted based upon the CPI at that time. If CPI is rising, it'll adjust upwards, but if CPI is declining, it'll adjust downwards. Okay, so I-bonds earn interest at a rate close to or higher than the current official CPI. So at some point in the future, when you either sell them or they eventually mature, you'll get back your principal plus the collective sum of all of the monthly interest you earned while you own the I-bond. Your principal is the money you put up in front to buy the bond, and the sum of all the interest payments is essentially a refund of all of the purchasing power your principal lost to inflation over the time that you held that bond. This is how an I-bond protects your money from the ravages of inflation. Pretty simple, right? And I-bonds they're a straightforward instrument to use. However, there are a number of nuances you'll want to understand. First, as stated, they track inflation using the Consumer Price Index, specifically the Consumer Price Index for all urban consumers, known as the CPI-U, which is calculated by the US Bureau of Labor Statistics. Now, there are a number of people, myself included, who think the CPI-U undercounts the inflation that we consumers and our money actually experience in the real world when buying gas, groceries, or paying for school and medical expenses. So while your money is being protected from the purchasing power erosion caused by the official CPI, it's not necessarily protected from the true inflation that your household experiences. Second, the only way to buy I-bonds is directly from the US Treasury. You can't buy them or even hold them in a brokerage or retirement account. Don't worry though, purchasing them is pretty easy. In a few moments, I'll give you a quick walkthrough of how to use the government's Treasury Direct website to do exactly that. All right, third, you can only buy a limited amount of I-bonds each year. An individual is limited to buying $10,000 worth through the Treasury Direct website. And those receiving large refunds from the IRS can use up to $5,000 of that to request additional I-bonds. That makes a total maximum of $15,000 a year per taxpayer. So if you have a lot of capital you're looking to protect from inflation, I-bonds might be too small of an option to make any real difference to you. But that doesn't mean you still shouldn't take advantage of this program. And also, at the household level, you can sock away a fair amount more as every family member is able to buy up to the $10,000 limit. The same is true for any legal entities like LLCs or trusts that you may control. So a family of four with a household trust should be able to buy $50,000 worth a year. Okay, fourth, the interest paid by I-bonds accrues, meaning you don't receive regular payouts. You only get your proceeds when you sell the bond or it matures. By the way, these bonds have a 30-year duration, though most people don't hold on to them for that long. Now, whether you hold these bonds all the way to maturity or you sell them sooner, when you do, the government will send you a check which will be comprised of 1, the original principal that you put in to buy the bond at the start, and 2, the collective sum of all of the accrued monthly interest earned over the time that you held the bond. And note, if you hold your I-bond for less than 5 years before selling it, there's a penalty. You'll forfeit the last 3 months of interest earnings. This isn't really a huge deal, but it's worth being aware of. And if you sell the bond after holding it for 5 years, there's no penalty at all. Also, you can't sell your I-bond within the first year of holding it. The government won't let you do that. So just be aware that you're locking up your capital for at least 1 year when you're buying an I-bond. All right, 5th on the list. An I-bond is a guarantee from the US Treasury, so there's no loss risk. You will receive your principal back no matter what happens. Some folks wonder that, if CPI were to go negative, would that eat away at an I-bond's principal balance? Nope. Says the Treasury, quote, "In periods of deflation, the bond's redemption value won't decline." 6th, I-bonds receive favorable tax treatment. Interest earned on an I-bond is exempt from state and local taxes, and federal taxes are deferred up until the year the bond is sold or matures. All right, so for those of you wondering how to actually buy an I-bond, let me show you what the process looks like. It's so easy, anyone can do it in just a couple of minutes. First, go to the treasurydirect.gov website. If you haven't done so before, open an account by clicking this link over here, and then clicking on the Treasury Direct link here. Then simply follow all the account opening instructions as prompted. And one pro tip here, the Treasury Direct website's a little clunky, as A, it's designed by the government, and B, it has a ton of security precautions in place. One thing that takes a little practice to get used to is that you can't use your browser's back button. Can't do that. If you do, it logs you out of the website and you have to start over. Yeah, it's a bit of a hassle, but I guess it's worth putting up with if it keeps your money more secure. Okay, once you have an active account at Treasury Direct, then you want to go back to the homepage and click the Treasury Direct link under Account Login. Once you've successfully logged in, you'll arrive at your Treasury Direct My Account homepage. Click on the tab titled Buy Direct. Click on the Series I radio button, and then click Submit. Enter the amount of I-bonds you want to buy in the Purchase Amount field. Make sure the bank account you want to use for funding the purchase is the correct one selected. Also, make sure you've got sufficient funds within your bank account before attempting to make your purchase. Also, make sure the single purchase radio button is selected unless you want to set up a recurring purchase program. But for now, let's just go with a one-time purchase. If you don't want the purchase made today, enter the date you want it made on, and then click Submit. Review the information here. If everything looks good, then hit the Submit button again, and you're done. It's that easy. So in summary, I-bonds have these 3 nice advantages. Number 1, a high relative rate of return in today's market environment. A 9.6% annualized return looks awfully appealing when the 30-year Treasury bond is yielding 3%, 5-year bank CDs are yielding 0.6%, and money market accounts yield just 0.09%. And it looks especially attractive versus the financial markets so far this year, with the bond market down 10%, the S&P down over 20%, and the NASDAQ down nearly 30%. Number 2, you won't lose purchasing power to inflation, at least as officially measured, and you won't lose your principal. Both promises are backed by the US government. And number 3, interest earned is tax advantaged. No state and local taxes, and federal income tax applies only when you redeem. And in terms of their cons, which I hate to use that word here, is that you can only buy a limited amount. That's the $10,000 per person per year limit. Number 2, there are some holding restrictions and penalties, but they're pretty darn minor. And number 3, your return will vary as the CPI fluctuates and the inflation rate component of the interest earned is recalculated semi-annually. So if we enter a period of disinflation, which experts like Stephanie Pomboy, David Rosenberg, and Jim Rickards predict we will, today's current 9.6% annualized return could drop to something much lower. It's worth noting, too, that the latest issued I-bonds have their fixed component of their total rate currently at 0.0%. So if CPI were to drop all the way down to zero or even lower, these bonds wouldn't earn any interest at all while those conditions are in effect. It's also worth noting, too, that I-bonds are a defensive vehicle. They offer you a 0% real return on your money, meaning you don't lose purchasing power to inflation, but you don't gain any on it either. If you're looking for returns that beat inflation over time, by definition, I-bonds won't do that for you. So, are I-bonds right for you? Well, if after viewing this video you're not certain, talk to your professional financial advisor and get their take. If you don't have a good one to ask, then consider talking with one of the advisors Wealthion endorses to get their opinion. It's completely free and there's no obligation to work with them. These are the same experts you see with me on this program every week. So to schedule one of those free discussions, just fill out the short form over at wealthion.com. Now, in wrapping up, there's another popular investment vehicle for defending against inflation. It's called TIPS, which stands for Treasury Inflation Protected Securities. I initially intended to address both I-bonds and TIPS in this video, but I eventually decided it was best to keep this one solely focused on I-bonds and to then do a second video dedicated to comparing and contrasting them to TIPS. So keep your eyes out for that next video. It should come out on this channel early next week. But the punchline is that there's pretty much no limit on the money you can invest into TIPS. There's no constraint like the $10,000 to $15,000 annual limit per person that I-bonds have. They're also super liquid, and they don't have any holding period penalties, and they issue regular semi-annual interest payments, so you receive cash flow while holding them. Know, though, that they're not a guarantee the way that I-bonds are. Your principal can go down along with inflation. Also, TIPS have a less favorable tax treatment than I-bonds. Like I said, though, I'll go into greater depth on this in next week's video, so there's more to come. And speaking of more to come, if you find these short explainer videos of value and would like to see more of them, please let me know in the comments section below. Feel free to suggest any additional topics you'd like to see covered in a future video as well. And if you want to see more of these, please support this channel by hitting the like button and then clicking on the red subscribe button below if you haven't already, as well as that little bell icon right next to it. Thanks so much for doing that, and thanks so much for watching.